Harmony's released its results for the second quarter today, and with production at Kusasalethu still weighing on the miners' overall performance, the company is seeing a headline loss of 496 million rand compared with 266 million in the previous quarter, and that's with production down 10%. But the plan is to return the mine back to profitability by the end of the fourth quarter of 2015. And Graham Briggs, CEO of the company, joins us now. Thanks so much, Graham, for your time today. So you've said before that Kusasalethu, without restructuring, will not survive. As you move closer to the fourth quarter of 2015, what kind of traction are you making at the mine?
We're making some progress. It's been a fairly difficult journey. This particular quarter was, there were some external factors like the illegal mining we had. We had 4 fires at that operation, but we have commenced restructuring. It's quite a big restructure. We're basically taking out 7 levels of the 12 levels. So we're going to focus on 5 of the higher grade levels, and that means that we've been able to eat away at some of the, call it, fixed costs of the operation. You know, we need to get all our operations profitable, and that's the objective. We've dealt with some other restructuring during this quarter. So there's quite a lot of initial cost to any restructuring, and that's what you're seeing in the financials. But once we'll see the benefits of those in the future.
Labour relations on that can't be easy. From the meetings you've had with unions to evaluate the options at your disposal at the mine, what's your sense of the tone or the temperament right now?
It's always difficult going in through a Section 189 process, a retrenchment process, but we're doing it under the auspices of the CCMA, so we are getting through those, but it is obviously difficult.
Yeah, I ask because it's in a context where this year's wage negotiations are expected to be one of the key challenges that face the gold mining sector this year. So what are your expectations on that front?
Yeah, it's not going to be easy, that's for sure. There's, you know, this is, I think there's quite high expectations from the sort of platinum sector and everything like that. The reality is that gold is completely different. I mean, we're price takers in the gold. We've had flat gold prices in rand terms for some time now. The costs have been escalating. Our main costs, of course, are labour and electricity. That amounts to about 70% of our costs. So we're going to have difficult negotiations, no doubt.
Still, even with that underway, a spanner in the works is South Africa's power predicament right now. One assumes that to stay flexible and to work around the power issues presented is really hard. So to what extent are the rolling blackouts and the kind of usage cutbacks you've had to endure putting that target of a return to profitability at risk?
It certainly puts a large amount of pressure on us because they don't actually black us out, but they actually have requests, minus 10%, minus 20%. And that means that we have to stop things. We have to stop mills or stop hoisting. That affects production. During last quarter, we lost about 50 kilograms. However, this quarter, as you've seen from the news, there's a lot more reductions in power. It disrupts the business. The not knowing, the not being able to plan is very disruptive.
Yeah. What seems to be the theme industry-wide is targeting then the non-performers that you can't afford within this operating context, selling the underperforming assets to maintain your profitable ones. So you've got insufficient power, labour tensions, rising costs, uncertain regulatory environment with 90% of your production in South Africa. Does this force your glance outside of South Africa? What's your assessment of that opportunity?
I think there are several things here. I mean, one is that Harmony has been able to take other people's assets, which we've bought in the past, and squeeze more out of them. We are efficient miners. We're able to produce more gold out of assets that would have closed earlier. So I think that's a real positive for Harmony. We are able to do those sort of things, and therefore we're quite resilient in that. Now, having said that, of course, eventually ore bodies get to their end, and then you have to look for new ore bodies, and hence a lot of our effort in PNG, where there are fantastic ore bodies. Golpu is just a fantastic 20 million ounce ore body with 9.4 million tons of copper. It's fantastic, and we'll continue to explore in that country because it's really elephant country when we're looking for elephants.
Goldfields has bought from Barrick. Anglo's has sold to QKR. It speaks to a tough environment that's out there, but also competition for assets. What's your muscle within it? Because it also speaks to significant financing needs.
Yeah, we can't go out there and tap shareholders and ask for money unless you've got actually a reason for those funds. And so, we think that we operate well in Papua New Guinea. We've been there for 12 years now. We operate well in South Africa. We know the environment. To go into another country, completely new country, we would have to buy a significant asset. We couldn't buy another asset that requires a lot of capital because we don't want that capital to compete with Golpu. Golpu is a significant capital asset going forward. When it's in production, it's got very, very low costs, so it's a fantastic asset. And we don't want to have that competition with capital if we go forward.
Of course, that's the one thing to consider. The other thing is cash balance at 2.2 billion from 1.3 billion in the previous quarter. Net debt at 1.7 billion from 771 million. And it seems to be swinging the wrong way. So how do you get a handle on things? And do you need to raise capital for new acquisitions to finance debt?
Yeah, our cash balance doesn't worry us, in that net debt figure doesn't worry us, because a lot of those issues are one-off things in our cash thing. Retrenchment costs, yes, it's a cost, but we get payback in the coming quarters. We had some movement on inventory, they once off, so won't repeat, and we'll get some benefits going forward. So that's, because of our quarterly reporting, it's a bit of that's the reality, but there are benefits going forward.
We've seen write-downs at your South African mines, but at Papua New Guinea as well. You talked about a plan to develop those deposits in scalable and affordable steps a while back. The market didn't take too kindly to that news. What do you say to win them over on that one?
I think when we released our Golpu results, we released them on the 15th of December. Now in South Africa, 15th December is indicative of holiday season. We saw our share price between the 15th and sometime towards the end of January going up 70%. That's what our share price reacted. That's what our shareholders thought of us, which exceeded most other companies, which went up sort of somewhere between 30 and 40%. Now, the difference in that increase in share price is Golpu. So people are starting to give us credit for this is a great asset and it's going to be a great mine one day.
Well, let's leave it there. Graham, thanks so much for having joined us today. Of course, Graham Briggs is CEO of Harmony Gold.